Okay, great. So our third speaker is Adam Green, consultant to the FCA.
Good evening, everyone. Basically, this evening we've heard a lot of interesting ideas, and I think Kim's challenge to the industry is something which everyone in insurance has been thinking about for a while. And part of the conversation I wanted to have this evening was really around some fascinating things about why the industry is the way it is, and things that regulation and some of the changes. But as I was chatting to people this week, I stopped to think and actually thought, what is it about the industry that makes it different, and what is it that makes it special? Because you can work in insurance for quite a long time and not really necessarily think about what insurance is. So that's part of what I want to talk about this evening, both about the products but also about the industry, and then throw it open to the floor to try and get people to sort of engage and think, actually, why is it that insurance is the way it is, and some of the challenges that Kim put forward. So this is what we're going to cover this evening. First of all, I'm just going to introduce myself briefly, talk about why insurance is special, the insurance ecosystem. So we've heard a few terms. If you're familiar with the market, it's obvious. If you're not familiar, so for the entrepreneurs in the room, it kind of helps to understand when we use these terms such as reinsurer or intermediary, what we're actually talking about. The regulators, just briefly, going back to Kim's point, and also some number of other conversations I had with other people this evening, which is really to try and understand a little bit about what they want to see in the market. And then really just looking at a few examples of whether the insurance industry really is a laggard or a leader in terms of innovation. Just to introduce myself, I'm an independent consultant now. For the last year or so, I've been consulting to the FCA on a number of different initiatives they've been running, so their transition from the FCA, from the FSA into the FCA, and also exciting directives such as Capital Requirements Directive for asset managers, and also AIFMD, which affects the asset management industry. But before that, I've been a consultant at PricewaterhouseCoopers, consulted across the insurance industry, and many years before that, I was a regulator who regulated at different times the insurance industry. So I've seen it from different dimensions. My consulting company is called Syntomai. And when I named it, what I really wanted to do was to choose a name which stood out. And one thing that's true about financial services and regulation is that it's not brief. It tends to be, just as Kim pointed out, it's long, it's complicated, and it's verbose. So Syntomai means concision or brevity, and hopefully that's what we're going to be able to do this evening. Very quickly, just to stop for a moment and think about insurance, because this evening when I came in, there was a couple of conversations I had which actually centred around this concept of what is insurance. So we've got a lot of action in peer-to-peer, and peer-to-peer lending is not the same as peer-to-peer insurance, primarily because insurance is a different product. So it's a simple concept, but it's a very bizarre thing, and this is the thing about insurance, which is it's made backwards. It's possibly the only product on the planet that you pay for up front, continue to pay for years, quite a lot of money in some cases, and never actually use. But yet we feel it's a good thing to go and buy, and we feel that it's a good thing generally to go and protect yourself, from health and cover. But it's a product that's different. It's fundamentally different. It's not something we can consume today. So very much, as Kim was showing, and also from Richard's slides, it's not something that you get any gratification from. It's something you have to think about the future, and that's something we're very difficult, not very well set up to do as consumers. And I think in terms of the industry and in terms of the product and the innovation, some of these concepts are quite important to dwell on for a moment. So just very briefly, we've touched on this a couple of times this evening. This idea that insurance is not necessarily a product that you buy like a sandwich or an Apple computer. Insurers see it as a partnership. Your deductible is actually self-insurance. You insure part of your own liability. Somewhere between your loss and the insurance obligation is where the line is drawn. And this is, again, something that's quite different about insurance products from other products. There isn't a hard and fast rule. Loans are a lot easier to understand. You've got some basic numbers on the page, you've got an interest rate. It's a lot easier to work with. Insurance, there's a fuzzy line, and it's that fuzzy line which causes a lot of the misunderstandings. Going back onto this, we've touched on this again this evening. Selling. Insurance is about selling mostly, and it's a very expensive business to get insurance policies out into consumers' hands. There's a large intermediation chain. Lots of money is spent on brand and advertising. It's not something that people willingly queue up to buy. Life insurance particularly is something that nobody really feels warm and fuzzy about. They don't run in off the street to go and buy term cover. They have to feel that peace of mind, they have to be in that frame of mind when they buy it. And so the cost of sale is an enormous part of the insurance market. It consumes capital. So capital is the money that you use to buffer yourself against unexpected losses. So in short, insurance is a very expensive business. Life insurance consumes vast quantities of capital. It's not something you get out of bed as a venture capitalist and you back. If you look at the numbers to set up an insurance company, it's not you can't bootstrap it. It just is money. And so in order to try and innovate in insurance, you have to understand who's going to have that money as a backstop. There's different models of trying to acquire it, but essentially that's your barrier. You've got to have capital, this thing that absorbs loss. The sting in the tail. Insurance is all about the unexpected. And again, this makes it slightly different from other products. Most products you sell, you have a fairly good idea of what's going to happen. You sell an Apple computer, the worst that can happen is it breaks. With insurance, if you get your selection wrong, things can go badly wrong very quickly. So very much like the curves that Richard was showing, you have an expectation about how these products will behave. You have an expectation about the buyers. And when that deviates, your experience as a company can go down very quickly. So when you're selling your policies, you have to have a very clear understanding about how to manage that risk and all the different ways in which that risk can come back and bite you. And again, that makes it slightly different if you're setting a startup or you're innovating. And finally, it's a team sport, and we're going to come on to that now. This is a very simple overview of the insurance industry, and there's all kinds of bits missing. And I'm not proposing to go through it in detail, but the key things to think about in terms of business model for the existing insurance industry, and these are the things that Kim's challenging, is the way it's set up. So on the left-hand side here, you have the buyers, consumers, businesses, and governments. Governments are big insurance buyers. If it's Australia, you insure your submarines. I think Colombia insures its jet fighters. So there's a claim you don't want to argue with. But if you look at the mid-ground, this is really a lot about the insurance industry. You have these intermediaries. The intermediation chain, particularly in general insurance, is very deep. So we have brokers and intermediaries. In the general insurance chain, the policies that you've bought in this room, without you ever realizing, might have gone through 10 layers of middlemen before it reaches you. You won't see it, you won't know it. And to you as a buyer, it often doesn't make any difference. But all those middlemen serve a purpose in the current insurance chain. But they also add cost and friction, and they also make the market look the way it does. On the other side, you have claims. So there is actually a whole bunch of companies out there that specialize in managing claims. So it's possible for you to buy an insurance product, to not really have any idea who your insurer is, to never actually speak to that insurer, and then to have your claim managed by somebody else. So your entire experience of that product, end to end, you never actually touch the company that sold it to you, ultimately. Again, a very sort of unique experience in the insurance industry. And over here is a very simple representation of some of the key players. We talk about insurers. We've mentioned reinsurers this evening. That is a very large global market, and it's there to manage the tail risk of insurance and to effectively manage, I suppose, the collective pooling and financing of the industry. The thing about reinsurers is they know an awful lot about their specialist area. And if you're an insurer, you can't, or you don't want to in all cases, actually take on all the risk. You write a policy, and the last thing you want to do is to take all the risk associated with that policy. So even if you have a whizzo idea, you still have to go and talk to a reinsurer friend and lay off some of that risk. And this is where you have a lot more players in the game than it might be obvious at first. At the bottom, we have Lloyd's of London, who is a very special insurance market based just up in Lime Street, and if you've ever seen it in a fantastic Richard Rogers building, it is a unique institution. It is an innovative market, very interesting market, based mostly around drinking at lunchtime. But once you've had 3 pints, you can insure an aircraft carrier or a racehorse, if you so wish. So Lloyd's of London is an innovative market. If you want to see entrepreneurship, raw entrepreneurship, some of the brokers and some of the guys at Lloyd's embody it. It's a very hard market to get your head around. It's a club, and it's hard to regulate, but it's pretty special, and it does something quite useful for the insurance industry. And finally, I'll just put the actuarial profession up. So hands up in the room. It's got at least one. How many people here are actuaries? Yeah, brilliant. So actuaries are fundamental to the insurance industry, increasingly more so. The oldest profession for professionally managing... Almost. The oldest profession for professional risk managers. So a lot of the discussion today about analytics and big data, the actuaries have been dealing with as a profession for, in some cases in the life industry, hundreds of years. And the actuaries represent a fantastic asset to the insurance industry, but also potentially some of the means for resistance, because there's obviously a profession which has got its own views. Very quickly, these are the regulators. Now, originally I was going to sort of wax lyrical about all the different fun things that regulators do in this market, but just to make you aware that there's actually quite a big number of players, and actually one I left off here was law. So insurance law is actually a very, very important part of this market, and there's things you just can't sort of fiddle with easily. But in the UK, we have now the Financial Conduct Authority, based in Canary Wharf. We have the Prudential Regulatory Authority, which is a subset of the Bank of England. For the Lloyd's market, the market polices itself, as well as having both the PRA and the FCA oversee it. And I've also put down the actuarial profession, because the actuarial profession actually has a very strict code of conduct and a very tight-knit community, which means that lots of standards and self-policing goes on. So what do the regulators want to see? Like Kim was saying, regulators for conduct want to see that you're not going to rip anyone off, you're treating them fairly, and that you're basically going to honour the promise that you've made. The problem with that is that sounds lovely, but when it comes down to it, what they really want to see is proof that you're doing that. Evidence, documentation, policies, records. And this is where it starts to get a bit trickier to work with them, because they don't just take your word for it that you're a decent, nice person and you're going to do right by your customers. They need to see it, and they need to see it ahead of time, and then they come and check that you're doing it. And so a lot of what the FCA does is come up with different ways of trying to find people a way of expressing and demonstrating that they are doing the right thing. Now, once you get into that mindset, it's not as crazy as it sounds, but it is something, again, for a regulated industry, it's not like a normal startup community. It's not something that you're normally used to, because there's somebody here who wants to see the paperwork before you're allowed to go and do things. And that kind of changes the game a bit. The PRA, who's the Prudential Regulatory Authority, they're looking at solvency. And again, in this area, we have a heavy European remit. So one of the big game changers that's happening at the moment, in fact, today, after months of stagnation, there was the green light for the final phase of what's known as Solvency II. And Solvency II, if you've been in the insurance industry, so just quick show of hands, who here is familiar with the word Solvency II? Okay, keep your hand. Who here likes Solvency II? Fantastic, there we go. So this is possibly the biggest change to the insurance industry in decades. It's a very complicated, very heavyweight piece of legislation, and it brings in a lot of requirements about governance and capital calculation, and it makes the business of insurance just that bit harder and just that bit more expensive than it was before. And this is phasing itself in the next couple of years. So this is all the background that you have to work with. So in that, before we go on to the panel discussion, and the questions and answers, which will be a good sort of chance to see whether the industry can change. A couple of examples of maybe where the insurance industry is innovative. So, for example, in marketing, life companies for hundreds of years have understood the power of brand. They have been brand-centric. The Prudential was one of the leaders in being able to create the man from the Prue, large offices, branded up, literature, very strong brand identity, because you don't really understand what you're buying when you buy life cover, but you do understand the brand. So a lot of brand development was done a long time ago by life companies. Cloud computing, recently, very large life insurance company in the UK, this is about 3-4 years ago, 100 million to virtualize their entire actuarial systems. They're in a global Microsoft Azure cloud. They can perform calculations anywhere in the world securely, and they've completely they've just completely separated themselves from the physical world. Very advanced, very interesting technology, very clever idea. So again, we're seeing very heavyweight cloud computing plays in the insurance industry because it helps that industry. Social media. In America, if you work with Liberty, they'll try and friend you on Facebook. Why on earth would you ever want to speak to your friend's Liberty on Facebook? Well, it turns out that very much like we've been talking about today, it means that they've got a bit of an insight into your life, which makes you a better risk. And don't friend your insurer on Facebook. And finally, I think that probably the best one is coming back to Lloyd's. In Lloyd's, you can insure your moustache if you want. So for Movember, or for innovation, you can insure the X Prize. So if there's anything that is insurable, there is somebody who will take it on. And that's really what I wanted to finish on, which is the insurance industry has been innovating for a long time. And the question is how is it going to innovate to deal with digital?
Thank you very much, Adam. Let's take some questions.
Adam, that was a fantastic presentation. Really enjoyed that. One question I have, though, for this audience here is that you've painted a picture that makes it sound really difficult to innovate or for entrepreneurs to get into the manufacturing of products. Do you think there's a greater opportunity for them within the distribution of insurance products?
Yes. I think the long and the short of it is that if you look at the overall industry and you look at what's happening and what insurance is, manufacturing of insurance is tricky. It's tricky because there's natural barriers to entry, but it also has this regulatory overlay. The nature of the product, the distribution of the product, and also the machinery of the industry, I think, is absolutely ripe for innovation and entrepreneurship.
I'm Matthew Walker from Whoosh. You had on your list you're going to talk about disruptive technologies, and could you cover that briefly?
I'm going to say 15 minutes is always shorter than you think it is. I think the question with disruption, and what I was going to say about the nature of disruptive technologies, is certain things are possible in the insurance marketplace. There is certain disruption that can be achieved, and a lot of the I think the perceived barriers are to do with either regulation or the current shape of the market, and none of that's fixed. And the disruptive technologies that we're starting to see are creeping in, and it's creeping in obviously from other areas. So the moment you have an app on your phone from a bank, you kind of start thinking, why is there, how do I get insurance, or how do I interact with insurance in the same way? And insurance companies aren't really thinking like that, but somebody will, and there's no barrier to that distribution chain. And I think what I was sort of wanting to cover on the idea of disruption is that in finance, it's a subset, particularly in the UK, so London is a leader in the world. We have this very strange idea of entrepreneurship, which is this idea, and this was framed to me when I was out drinking a little while ago with some of the guys who were doing Airbnb, and they were saying, well, look, in the UK, when you want to innovate, you say, oh, excuse me, are you guys doing some business? Hang on, there's a little gap between you. There's a little niche. Can I kind of come into that niche? And I don't want to upset you, and I don't want to upset you, but I'll just come into your little niche. They said, in America, we wake up and we go, I'm going to wipe you out. I'm going to wipe out every single one of you. Taxi drivers, I hate taxi drivers. I'm going to destroy all the taxi drivers. Hotels, never liked them in the first place. So that's how we do innovation in America. And part of what they wanted to try and they were trying to understand in the UK is how we can have such a powerful industry, particularly in financial services. But when you talk about innovation and disruption, it's always about refinement and niches, when in fact some areas of insurance really can be reworked. It's possible to rework the distribution chain. It's possible to rework the market. The question is, what is it that's going to make that happen?
From Comac. I was wondering, just isn't the first actually step to innovate to kind of go a step back and simplify the product so they're actually more suitable to new distribution channels, like social media, for example?
It can be, and I think that's very much what Kim was putting forward. The thing with the simplification in insurance is that for every time you want to take a clause out of a contract, or simplify the way in which it's communicated, somebody will pop up and say, you're making it less clear, or you're making it less predictable. And I think part of the challenge of getting closer to the customer is to try and understand precisely what it is they want insured. So the clearer you want to make it, the less optionality you have to have. And so one of the questions is that what consumers want? When they talk about travel policy, it's actually a bundled product. There's actually lots of bits in there. And to make it simpler, to make it clearer and easier to get with, you might have to break it out and break it down. And that's something the industry hasn't done, because as you break it up, you make it harder to sell. So part of the question is, does digital make it easier to sell niche solutions, which make it easier to sell in itself?
We can take, here we go.
Dylan, entrepreneur, used to work private equity and investing in financial services. I'm quite interested to hear how you actually consider the distribution being able to be disrupted, considering that you're dealing with an industry which has been reluctant to any change in many ways for a long time. I think, is it 2 billion the value of kind of technology, of wasted technology projects within Lloyd's of London? I also and everyone, and I think one of the fundamental reasons is that everyone in the value chain is actually making really good margins. I mean, underwriters and brokers are making about 10% EBIT margin across the board. So why would you really kind of disrupt? When people have tried to disrupt in the distribution and giving effectively greater insights for underwriters to better understand the risk, most of the guys who've actually tried to disrupt that kind of distribution have been kind of faced walls, because you're effectively having to dislodge kind of well-established drinking buddies without being too facetious, and therefore have actually struggled to actually being able to kind of bring a better quality distribution to underwriters. And therefore, I suppose, having seen that, I'm more with you saying absolutely, and this is what I'm trying to explore here, absolutely keen to see how we can disrupt this industry. But when you've got such a really kind of entrenched kind of system in place, maybe that is why in Britain there's so much kind of more looking at the way they can go into the small place rather than try and take out people. It's because there's less kind of openness to actually have new entrants try and propose something quite different and quite innovative. And I'm sort of just keen to hear your thoughts on that after this long diatribe.
I think, well, I was going to say, the diatribe clearly comes from someone who's looked at this and seen the problems. As Mark was saying, it's not going to be easy. And there is absolutely no way you can dislodge the drinking buddies. That's pretty much how the industry was founded. It's worked very well until now. But what you can do is, if you can start connecting, and you are starting to see this in the banking space, if you start connecting with customers directly, you can start disintermediating the chain. So the best example has really been the supermarkets, and we're looking at the finance, Tesco's Finance. When they started up a few years ago, the branch network and a lot of the bank managers were incredulous. They just weren't interested in the idea that a supermarket could, operate in a financial way, or indeed even set up a bank. And slowly but surely, you've started to see the brand taking over, and people like Tesco products. You can, buy that kind of thing. That's a new distribution channel that no one ever thought about, and it's also a big player. Now, unfortunately, you can't all be Tesco's, but it's a big player which people didn't see coming, and they weren't prepared to deal with it. And one or two people in the industry said, "Okay, I like that model. I'll work with you." And the challenge, I think, is that in banking, where we're starting to see not just the new really innovative technologies like peer-to-peer, but just generally better practices at connecting with customers, one or two firms or one or two technologies will arrive which will actually work. And the moment they do, those margins come under pressure. And I think in the past, there wasn't any other channel to buy insurance through. You buy it through brokers. Well, now people buy all sorts of things on the phone. In fact, people are quite used to shopping on eBay. And there's a psychological shift. And the theory, yet to be borne out, is that can change that distribution channel. But you're right, it's not easy. This is an entrenched industry.
I'd like to add to that as well, though. Sorry, I don't want to jump in, but I just want to add to that. There has been recent regulation, like RDR, and Retail Distribution Review. And basically what you've got now is you've got a huge advice gap in the market. So basically intermediaries are now looking upstream because that's where the most profits are for them. So you've got a huge part of the population, I think it's over 5 million, who have either chosen not to seek advice or are unwilling to pay for advice. So if you could come up with something that's a direct-to-consumer offering, then you are automatically changing the industry. Because if you can get a footprint there, then maybe you can work upstream from there.
Yeah, on RDR, this is all terribly exciting regulatory stuff, but RDR has just basically said to the advice industry, you can't charge commission on products. It's all got to be paid for advice, and this is sort of torn up a very long-standing tradition inside the industry. But estimates are somewhere between 5 and 8 million people who currently receive or have until recently received financial advice from a financial advisor will not qualify to be super high net worth and therefore pay the fees. So there's about 8 million people who are used to shopping for financial products who are in the next year or two going to be floating around the market. And nobody's really sure what they are going to do or how they're going to serve them, but it's something that hasn't happened before.
I was just going to say something positive for the entrepreneurs in the room that are looking at this sector. About 40% of the value chain is captured through distribution, which means for every policy, 40 out of £100 you can get as a distributor and it is pretty rich pickings from that perspective. So I would encourage people to think about the distribution of these products quite heavily. The other one that has disrupted very well, if you think that nobody can do it, of course, is the aggregators on the general insurance side for motor. So they've come in and they've cleaned up, and 35% of all motor is now done through them. And what essentially all they are is a branding and marketing agency, and that's it, with some good technology on the back end. So it is very possible. And RDR accelerates that, but RDR is one slither of the mass affluent market. You've still got the mass market that's never been served in the first place. So the opportunities are immense. So I'd keep cracking on with it. And we're certainly interested to hear if you come up with some whizzy ways of doing it.
Adam, thank you very much. Stay here.